Bank de France pulled every single last ounce of gold that they had stored in the Federal Reserve Bank of New York. Last time France did something like this, 1963, 1966, under President Charles de Gaulle. France repatriated over 3,300 tons of gold from U.S. vaults. Yesterday, I watched the market rip higher in the middle of one of the most dangerous geopolitical moments that we've had in years. The conflict with Iran, shipping routes under threat, a world that feels like it's coming apart at the seams. And yet the market, it's going up. Now, you could say, well, the worst has already been priced in. Maybe. But then I pull up a different chart and everything changes, because here's what I keep coming back to. If the stock market is at or near all-time highs, I think it might have broken them today. Why does it feel like your money isn't going as far as it used to? Why does it feel harder and harder for so many people to build real wealth? Even though markets are supposedly booming, the latest published CPI data showed headline year-over-year inflation in the US at 3.3% for March of 2026. OECD's recent update projects US headline inflation at about 4.2 for 2026, and that's on top of the 20 to 40% that they've taken from you in the past since the beginning of COVID. Now, you don't get any of that back. Plus, get this. University of Michigan just published the consumer sentiment reading at 47.6. This is the lowest in the 70-year history of the survey. So people don't feel rich. And I'm going to show you exactly why. Because what you're being shown is priced in dollars. And what I'm about to show you is what happens when you remove the illusion of the dollar. Let's start with what everyone sees. This is a chart of the S&P 500. Over the long term, up and to the right. Looks incredible, right? Record highs, strong performance. This is the narrative that you hear everywhere. Stocks only go up. Just stay invested. The economy's strong. But here's the problem nobody talks about. See, the chart is priced in dollars, and the dollar is not a stable measuring stick. This is the purchasing power of the dollar since the creation of the Federal Reserve. See, the dollar is constantly be expanding, constantly diluted, constantly losing purchasing power. And like I said before, you've seen 25 to 40% of your purchasing power erased since the days of COVID. And that's just the official numbers, which I've said this before is way understated. The way that they report. And if you ask anyone that is paying rent, buying groceries, filling up their tank with gas, if 3.3 sounds right. So when you see stocks going up, you have to ask yourself a deeper question. Are stocks actually getting more valuable, or is the dollar just becoming less valuable? And that's where everything changes. What if instead of measuring stocks in dollars, we measured them in something that can't be printed, gold, something that for thousands of years has held its purchasing power? Now we're asking a completely different question. How many ounces of gold does it take to buy one share of the S&P 500? Now, this is a chart of the S&P 500 total return over gold. And when you look at this chart, the story completely changes. The S&P 500 total return, that means capital gains and dividends reinvested, the best possible version of the stock market story, but now priced in gold. And what do you notice? It's not making new highs. It's not going parabolic. It's actually rolling over, and it's been doing so since about 2000. See, when this line goes down, gold is outperforming stocks, which means your stock market gains are actually losing purchasing power. This is the difference between nominal and real wealth. Nominal wealth is the number you see on your screen. Real wealth is what money can actually buy. Those two things are not the same. They're moving in opposite directions. And see, this divergence, it didn't start recently, but to understand where we are, you have to know how we got here. It actually started way before 2000. It started with the creation of the Federal Reserve. then the closing of the gold window by Nixon in 71. But let's walk through the modern version of the story. It's the year 2000, the dot-com bubble collapses, trillions of dollars disappear overnight, companies with no earnings, insane valuations, all of it unwinds overnight. And at that moment, the system had a choice. Allow the market to clear and allow what the Austrians would call malinvestment or bad investments to fail, or intervene. The choice: Alan Greenspan slashes interest rates, liquidity gets injected, and from that moment forward, markets are no longer allowed to fully correct. But that's when 2008 happens. And we don't let that reset either. We print our way out of that, and then COVID hits, and we print on a scale that the world had never seen before. Every single time the system needs a reset, we choose the same answer: more liquidity, more money, inflate the assets. And yep, it works in the short run. We can kick the can down the road for so long, asset prices stay elevated, markets recover, your 401k looks fine, but it comes at a cost. The currency gets weaker, and that's when you measure assets in gold. The long-term trend tells a very different story. And see, here we are today. The Federal Reserve, if you've been paying attention, is caught in a trap. They're caught in what economists call fiscal dominance, and it's a trap with no clean exit. They can't raise rates because we're already spending at an incomprehensible amount just to pay interest on our national debt, about 1 trillion in 2025 to be exact, more than our defense spending. And raising rates makes that worse, and it makes it worse exponentially. So if they raise rates to try to tamper inflation, we're in trouble. But they can't cut rates either, because inflation is clearly not under control. Like I said before, 3.3% headline, 4.2 projected by the end of the year, after 25 to 40% loss since COVID. So what do you do when you're trapped? There's really only one way out. You inflate your way out of it. You print enough money to devalue the debt. You let inflation slowly erode the value of what is owed. This is not conspiracy. This is monetary history. It is what governments have done since the beginning of time, every time they get to this point. And see, the people who hold their wealth in dollar-denominated assets are the ones that pay the price. And mostly it's the savers, the working middle-class people. Now let's bring this all back to today. We are seeing rising geopolitical tensions, trade disruptions, critical shipping routes being threatened, and yet markets just ripping higher. But again, not in gold. Because what you're seeing isn't pure market strength. It's a weakening of the thing that those markets are denominated in. It's monetary policy doing what it's been doing since 2000, which is push asset prices higher while the currency underneath them silently weakens. Now, here's what I really want you to pay attention to, because this just happened. Now, maybe just a coincidence, but France, between July 25th and July 2026, the Banque de France pulled every single last ounce of gold that they had stored in the Federal Reserve Bank of New York, 129 tons, $15 billion worth, gone, back to Paris. And here's the part that you should make every serious investor stop and think. You know the last time France did something like this? 1963, 1966, under President Charles de Gaulle. France repatriated over 3,300 tons of gold from U.S. vaults. De Gaulle looked at the American monetary dominance and he didn't trust it. He wanted French gold on French soil. That move helped precipitate the end of the Bretton Woods system. And in 1971, Nixon eventually closed the gold window. The dollar no longer backed by gold, and the world has been running on pure faith ever since. Now, Germany, which holds 37% of its gold reserves at the New York Fed, is facing renewed calls from economists and politicians to pull their gold home as well. Germany, Italy, other European central banks, they're all watching France, all asking the same question: why do we have our gold in America? They watched what happened to Russia in 2022, 300 billion in central bank reserves frozen overnight, And every sovereign wealth manager on the planet got the same message. And this is a little tweet from Trump. Could this be a warning? Could it be a hint? Assets stored in someone else's jurisdiction can be weaponized. France obviously isn't Russia, but the principle was established and central bankers have long memories. In my opinion, a lot of what we're seeing geopolitically in general has to do with the fight to protect dollar dominance. And it doesn't look like we're winning that fight if you really pay attention. The strait is still closed. We are running out of rare earths. The oldest European ally just pulled 15 billion of gold out of our vault. These are not small signals. So let's bring this all together. Gold is not a risk off asset. That's how amateurs think about it. Gold is an indicator. It's a signal that people are losing trust in the current currency. This is repeated historically over time, over and over again. It is a flight to safety for those who are educated enough to protect their wealth and purchasing power. And right now, central banks around the world are buying gold at a pace not seen since the Cold War. France just pulled theirs out of New York. Germany is being pressured to do the same. Gold hit nearly $5,600 an ounce earlier this year. This is not random. This is not a coincidence. This is a monetary shift, the likes of which we have not seen since the Nixon shock. Most people are completely unprepared for what's going to come next because they're still measuring everything that they have in dollars. They're watching nominal numbers go up on the screen and they're thinking they're getting ahead. In reality, their measuring stick is shrinking. So here's the point of the conversation today. Stop pricing your wealth in dollars, start pricing it in something real, because when you do that, the entire picture changes. The stock market looks very different. The economy looks very different. And the moves being made by sovereign nations right now look very different. So stop listening to what central bankers tell you and start watching what they themselves are doing. And it starts to make a lot more sense. At some point, something has to give. The question isn't whether this shift is happening. The question is, are you prepared or positioned for it? Now, if this video opened your eyes, share it with somebody who needs to see it, because the people who understand this early are the ones who will come out of this on the other side.